Tonight's story didn't start with a loud explosion or a declaration of war. It started with a quiet sentence in a press room in Beijing at exactly 9:37 a.m. Most people won't even notice it until their bank accounts start behaving differently. But on Thursday morning, China lit a match under the global monetary system. They didn't use missiles. They used gold. If you think that sounds dramatic, wait until you hear the exact offer China just made to the world's central banks, and why it targets the US dollar in the one place where it is completely defenseless. Now, real quick, if you value original investigative work on YouTube, do me a favor. Subscribe right now and drop OG John AG in the comments. I need to know you're here for the real analysis, not the copy-paste noise. This isn't just another news cycle. This is the opening round of a reserve currency fight that will define the next decade. China's central bank, PBOC, released an English translation of their domestic announcement. It was written in boring, bureaucratic language, and that is exactly why it's dangerous. Buried inside was an invitation. Foreign central banks and sovereign wealth funds can now store their gold inside Shanghai-based vaults, settle all fees in renminbi, yuan, and get guarantees that look as strong as the traditional Western standards. To a normal person, this sounds like a simple storage upgrade. But in the world of high finance, it's a doorway. It's a way for countries to pull their gold out of New York and London, wipe the dollar off their balance sheets, and conduct official business inside China's financial plumbing. The moment enough countries walk through that doorway, the dollar's network effect, the thing that makes it the king of the world, starts to crack. Why would anyone move their gold? Because in 2022, the West proved a point. Reserves stored in New York or London can be frozen, blocked, or weaponized for politics. That didn't just scare Russia, it scared every central banker on the planet. Bankers don't react with emotion, they react with math and risk management. China's pitch is simple. Bring your gold here, and we will build you a safer, neutral lane. Tonight, I'm going to map out exactly how this financial world war is going to play out, month by month, and what it means for your purchasing power. China's Shanghai vault system didn't just appear overnight. Reports suggest this has been years in the making: legal structures, transport relationships, and state-of-the-art security. But the real game changer is one word: allocated. In the Western gold ecosystem, there are two faces. One is real physical metal. The other is paper claims or unallocated pools, basically digital promises where ownership can get fuzzy. When China says allocated and segregated, they are signaling, we will give you the real thing that you were worried you aren't fully getting in the West. China is offering independent audits, physical weight checks, and, most importantly, repatriation rights. They know the world remembers the uncomfortable questions raised when countries tried to get their gold back from Western vaults in the past. By offering a defined timeline for delivery, China is removing the trust barrier. But here is the real weapon: settlement. China isn't just storing the gold, they are building a financial rail. Fees, swaps, and credit lines all settled in renminbi with that gold sitting right there as collateral. This is how you create a global reserve alternative without even declaring a formal gold standard. The dollar isn't dominant because the US is big. It's dominant because everyone else uses it. It's a self-reinforcing loop. But moats can drain. If you're a country trading oil or minerals, and you can now settle in yuan backed by gold in Shanghai, the dollar's moat starts leaking. Slowly at first, then suddenly. Now the question is, how does this actually start? Mainstream financial media will frame this as a symbolic move. They'll tell you the dollar is too big to fail, and in a narrow sense they're right. Massive systems don't collapse in a day. But their mistake is failing to realize that reserve systems don't just disappear, they erode. They leak market share until the confidence that holds the entire structure together simply snaps. And when confidence snaps, the repricing is brutal. I am going to map out a plausible month-by-month timeline of how this financial world war moves forward. This isn't prophecy, it's an analysis of institutional behavior. Remember, The dollar's dominance is not a law of physics. It is an infrastructure, and China has now built a competing one. Stage 1. Quiet discussions. The early months. A handful of commodity-linked nations will open quiet dialogues with Beijing. They will ask about logistics, legal protections, and insurance. These early movers don't need to move everything at once. Simply signaling their intent is enough to change the market's temperature. Stage 2. Pilot transfers, mid-year. A mid-sized central bank moves a small portion of its gold to Shanghai. This is a proof of concept to test the paperwork and delivery speed. If this goes smoothly, the fear factor for other nations vanishes. Gold market insiders will notice this first, followed by the currency traders. Stage 3. Headline transfers, year-end. Then, a commodity heavyweight makes a public announcement. If a major oil-producing nation declares they are moving gold to China and settling trades in yuan, it will shake the foundations of global markets. At this stage, what happens to the dollar? It won't vanish, but its marginal demand dies. When the world stops buying as many dollar assets, US interest rates must rise to attract buyers. As rates climb, the cost of servicing government debt becomes unbearable. The system gets caught in a trap. Either raise rates higher to save the dollar, which crushes the economy, or print more money to save the economy, which destroys the currency's value. Both paths lead to pain. When this geopolitical war intensifies, the first impact isn't felt in the headlines, it's felt in your purchasing power. Rising prices, surging bills, and the shrinking value of your savings are all symptoms of a reserve currency shift. So, what should you do? First, don't panic, understand. If your entire financial future depends on a single currency, you are exposed. Diversification isn't a sign of fear, it's a smart policy. The world's largest central banks are doing exactly this. They are creating distance between themselves and the old system to ensure they aren't caught in the crossfire. China's strategy is deep. Allocated gold is the bait to bring the world to the table. Audits and insurance provide the comfort. But settlement in renminbi, yuan, is the actual engine that drives nations away from the dollar. When nations buy and sell gold in yuan, the demand for yuan rises, and the dollar's global leverage weakens. When a reserve system changes, a massive wealth transfer occurs. Those holding only cash or paper assets often suffer the most. However, those who own scarce assets, tangible real-world value, often see their nominal values skyrocket. This system reshuffles the winners and the losers. From today, keep your eyes on these three things. Gold transfers. Are central banks actually moving physical metal from the west to the east? Trade settlement. Is the trade for oil and metals happening in currencies other than the dollar? Interest rates. Are rates being pushed so high to save the dollar that the underlying economy is starting to crack? This war isn't fought with tanks. It's fought with settlement control. Whoever sets the rules runs the world. The dollar's reign is not permanent, and those who recognize this reality early are the ones who will remain secure. Your job is to distinguish the noise from the signal. The future belongs to the prepared. Think clearly, stay sharp, and protect your future.